Yeah, thank you. And if I get in the way, just let me know. All right. Okay, cool. So the next one is the derivative trading strategies, and this is right, from your memos. Okay. Um, so there's only two sets of trades when prices are going up and when prices are going down. So whatever your forecast is. And then we have indices. We got the ETFs. And we got the stocks. Okay, got it. And remember that the ETFs and the stocks are the same. Okay, and that's a way for you to check it too. And if we think that prices are going to go up, we're going to buy forward contracts or forwards. You're going to buy futures, contracts. You're going to buy calls on futures. And you're going to write puts on futures. Now, did I do a presentation for you guys on, what forward contracts and futures and option contracts are? Did I do like an intro for you guys?
Yeah.
No.
No, you didn't.
No? Yes?
I don't think so.
No? Yes? I might have done one early in the semester, maybe earlier in the semester. If I didn't, I'll do one for you on Thursday. How's that? Okay. Give you a little bit more detail. Most other classes don't even get into the derivative contracts, but I think they're really interesting. They're extremely innovative. They're powerful instruments, and you should know about them. You should know about them. Okay, and then the ETFs. You're going to buy calls. Oops, sorry. For the ETFs, I would probably, to be accurate, I would probably add in another. I would buy the ETF. Buy on margin. Buy calls. And write puts. And then the same as the same for the stocks. So that's the, if you think that the prices are going to go up. And then when you think prices are going to go down, remember when you think prices are going to go down, this is also how you would hedge your portfolio. So if you think that values are going to go down in your portfolio, these are the trades that you would implement to hedge your risk. And I went over that last week with the portfolio theory. When you implement these, it bows out the efficient frontier, brings down the expected return because these are expensive, but it also reduces the risk more than the reduction in return, so your risk-adjusted rate of return goes up, and it bows out the efficient frontier. So here, and if you know these, you can pretty much replicate these down here. So you're going to write forwards. you're going to write futures. And you're going to write calls on futures. And you're going to buy puts on futures. Got it. Okay. And then if you think the prices are going to go down, you can sell. And then a lot of students, what they'll do is they'll say sell on margin. There's no such thing. It's called selling short or sell short. You're going to sell short. You're going to write calls. And you're going to buy puts. Okay? And then it's exactly the same thing for the stocks. Okay, and then those are your trades. Okay, any questions on that? No? Okay.
No.
Okay, awesome. You guys are awesome. And this one, we'll do the technical analysis. This one's a little bit different. Can I erase that? Because I'm going to need a little bit more space.
Yeah.
Yeah, that's fine.
Okay. Thank you.
Yeah.
My wife was kind of laughing at me the other day because I'm conducting my class in the garage. She named it Garage School. So I call it Garage School Rock is what I'm going to call it. And there's an internship that just came out from the FDIC. If anybody's interested in working for them, it's a really good institution. They have a 5-year training program, and a lot of people who go through their training program over the 5 years end up getting very high-level jobs, you know, in banks and other financial institutions, and kind of sets them up for an Ivy League MBA, actually, or a path to Wall Street, actually. So if anybody's interested, I can forward on that info. All right. Okay. So the next one is the technical analysis, and this one's a little bit more technical. So, so what you're going to do. Now, if you go to stockcharts.com and you put in a ticker, the graph that comes up, it's going to have the price chart over time. So it basically tracks the daily change or the daily price of a stock. So you can put in AAPL and then click on range and go back a few years, and you'll see that the stock price, you know, how it moves over a 3-year period. So obviously this is time. And I usually like to use a 3-year chart of 3 years of price data. Now, what you're learning in this class is fundamental securities analysis, fundamental analysis. This is technical securities analysis, so it's a little bit different. It's like behavioral finance. It looks at behavioral trends or movements in the stock price, and these technical traders use the price charts to be able to see what the stock price has done over time, and then to be able to identify behavior within the prices. And there's many different methods to technical analysis. One of the most famous is called Dow theory. The guy Dow has, developed a theory using price charts to come up with trading methods over 100 years ago. So that's a very popular one. Another one is a momentum, where they basically look at the momentum of the stock. So usually if stocks are in a strong upward trend, then the assumption is they'll probably continue in an upward trend. If they're in a strong downward trend, they'll probably continue, in a strong downward trend. And if the stock basically finishes its downward trend and kind of bounces off the bottom, then it's probably getting ready to either go up or down. And if it does go up, it's probably going to continue to go up. And if it goes down, it's going to continue to go down. So we like to look at momentum when we analyze stock charts. I can also use regression analysis and build a model with factors that will drive stock prices up and down, the stock price being the dependent variable. So I could use regression as a model. I can also use, and you probably learn this in your, hopefully you learn this in your statistics class or your quant class, is you can also use exponential smoothing as a method where you basically take the prior periods and you look at the momentum of the stock based on the prior periods, and then you can forecast where you think the stock price is going to go based on the prior periods. So that's another really simple but a really good method to use too. And then another one is the Wyckoff method, which is another methodology used by a lot of traders to analyze the stock patterns and then make the appropriate trades. There's a whole certificate that you can get or a concentration that you can get in technical analysis at Golden Gate University in San Francisco. They developed the first program next to the Finance Institute in New York. There's only two schools really that provide this type of technical training. One is in San Francisco, out of Golden Gate, developed by Hank Pruden like 30 years ago. And then there's another one out of the New York Finance Institute that does it too. So anybody who's interested in learning how to trade securities using technical securities analysis, those would be the two places I would look. Let me just draw like a stock chart, and you can see how the patterns usually form. Usually the stock price is, jumpy, and then it may break out, and then it could peak like this, bounce around a little bit, bounce around, and then drop. So that's kind of a, a normal pattern. First thing you do as a technical analyst would be to look at this part right here. This, as you can see, the stock price is bottoming. It's bouncing off the bottom. That's called the support line. So in that case, the stock is forming a support. And as you can see, the stock price was bouncing off the top, but it never broke out, or went any higher here. And that's called the resistance. And if you ever listen to Bloomberg, I usually try to have the Bloomberg on before every class. You can hear them using this vernacular when they're articulating stock movements on some of the major stocks. And then this point right here, you can see that information. This area right here is also called a trading range. It's called a trading range. It's also called a sideways pattern, because the stock price is moving sideways. It's also called the accumulation phase, and also called the consolidation phase. So accumulation and consolidation means that the stock price doesn't have any information that's come to the marketplace, that's going to move it either upwards or downwards in a strong trend. So the stock just trades sideways as it basically waits for new information to come to the market to shock it, either up, where there's a breakout to the upside, which is right here, and if it moved down here in a strong trend, it would be a breakout to the downside. So this point right here is a breakout to the upside. So you could see it broke through the resistance line and started to move up. Then, as you can see in this is a typical pattern too for a lot of stocks. You can extend that resistance line, and you can see that the stock price basically was bottoming or forming a support where the resistance line used to be. That happens a lot. So this becomes the new support. And when we do, based on Jade's recommendation, since we're going to be doing B of A, we're going to be conducting this analysis, on Bank of America. So I'll actually show you how we do it, applying, not theoretically, but the actual application. So this is the new support line. And as you can see, the stock price broke out to the upside and then started to form a new support right here. Now these two over here are called shoulders, are called shoulders. And this is called the head or the peak. And this formation is called a head and shoulders formation. So when stock traders start to see this formation of a shoulder, they know that a peak is coming. There's probably going to be a correction, another subsequent peak. So this allows them to be able to forecast where the stock price is going to go based on the formation of the head and shoulders. That's part of the Dow theory. And then, as you can see right here, that the stock broke out to the downside. And you can also see here that it looks like the stock started to form a support or a bottom where the prior support was months back or even years back. So being able to identify these supports and resistance along with trends are extremely important. Here's an example. You can see that the stock price really was moving in an upward trend there. And was actually in a downward trend here. And you can see it was trying to form a support right there and then also broke out to the downside here. This chart looks a lot like Yahoo stock price. It had, major upward trend for at least, 10 years, through 2000 to maybe 2007. It was in a pretty strong upward trend, and then it had some management issues and some other issues, and the stock price just got hammered, and then somebody finally bought the company out. And that created support and actually allowed the stock price to go up again. So this is basically just very simple technical analysis that allows you to be able to identify trends in stock prices. Does anybody have any questions on the? The other thing, there's on the stockcharts.com. There is two momentum indicators. One is called the RSI, and the other is called the MACD. And what you'll see is the RSI and the MACD will, when stocks are trading sideways, they're kind of going like this, and then when the stock price goes up, they'll go like this, down, up, and then like this, and then there'll be like a line in between here, and it'll show you momentum in the stock. And usually if it's going down, the stock price is going to go down, and if it's going up, stock price is going to go up. So it's a momentum indicator. These are momentum indicators that will help you to be able to forecast where the stock price is going to go based on the trend, in the stock price. And the MACD is pretty simple. It's basically the same thing. It's just another momentum indicator. And then usually underneath these graphs, they have trade volume charts where you actually have the volume of the shares, the actual trading volume, both the sales and the purchases of the stock, the total trading volume. And usually the trading volume will spike up when the stock price goes up, and will start to spike down when the prices fall. So there's a lot of buying momentum here when the stock price is going up, and there's a lot of selling volume when the stock prices go down. Okay. Any questions on that? Okay. I found that over the years that using the intrinsic valuations coupled with the technical analyses, I'm able to make better trades and make better decisions in my my stock trades. Okay. Any other questions or anything on that? And there's some other videos, you know, up there that probably get into a little bit more detail, but I think that that's enough. And then the last question is the intrinsic valuation methods. The first one's pretty simple. It's the perpetuity method. It's your cash flow. That's the CFO, so cash flow. Cash flow T plus 1. So when we're valuing stocks, we're always looking to project the cash flows for next period. And the cash flows can be it'd be EBITDA, earnings before interest, taxes, depreciation, amortization. So if I'm trying to value a company, I would take the next year's EBITDA or maybe earnings. Or if I'm valuing real estate, it would be net operating income. So if I'm trying to value a company or a piece of real estate or a portfolio of real estate, if I'm valuing the company, I could project out what their free cash flow. This is also, EBITDA is called free cash flow. And I could forecast the earnings for the company. I could forecast the net operating income for the properties. It depends on what I'm valuing. This is actually valuation at the entity level. So if I can forecast, you know, what the cash flows are going to be next year, and under the perpetuity model, you're assuming that the cash flows are going to remain flat and constant forever. So I usually put a bar over the top to signal that it's a constant cash flow. It's flat forever. And you're going to divide it by some discount rate. And I can use many factors as the discount rate. I can use the weighted average cost of capital. So if I'm going to buy a company and I can project out what their cash flow is going to be next year, I can divide next year's cash flow by the weighted average cost of capital to get the value of the company. I can also use the capital asset pricing model as a discount rate. And we all know that CAPM is the risk-free rate plus the beta times the return on the market minus the risk-free rate. So I could use that as a discount rate too. If I want to value stock, you know, actual shares, I can take EBITDA and earnings and do it on a per share basis. So I can use the perpetuity model to value the company, or I could use the perpetuity model to value the share of the company. So but the drawback to this model is that you're assuming that the cash flows are going to remain flat forever. The Gordon growth model is basically the perpetuity model, but it's just modified a little bit. And the Gordon growth model says that the cash flows are not going to remain flat forever. They're actually going to grow at a constant rate. So the valuation model is modified. You're still taking next year's cash flow, but you're taking the discount rate and subtracting out the constant growth rate. So if I think that the growth rate and the cash flows for the firm are going to go up in the future, it's going to drive my valuation up. And if I think the growth rate's going to go down, it's going to cause my valuation to go down. Okay. And remember, if the discount rate goes up, the valuation goes down. If the discount rate goes down, the valuation goes up. Okay. Any questions on that?
No.
Okay. Okay. I'm gonna erase this top part. So hold tight. How am I doing on time? How much time do I have? How much time do I have?
45 minutes.
How much?
45 minutes.
Okay, great. Thank you. I gotta get a bigger whiteboard. So let's do the multiple approach. Okay. All right. So the multiple approach basically says the value using the multiple approach is the same cash flow. CFO P plus 1 times the multiple T plus 1 equals the value using the multiple approach. Now the question is, you know, what's the multiple? Okay, so if I'm valuing a company, what I want to find is the this is what the investment bankers and the venture capitalists, this is how they think. So if I can find sales prices for similar firms that have just sold, and I divide it by the EBITDA, you know, or the earnings, I'm going to get an income multiple. I'm going to get a multiple to the cash flows. So if I can find, let's say, 3 companies that just sold, I can calculate their multiples, apply the multiples to my company or the company I'm looking to buy, and I can come up with the value of the company. That's the enterprise level. And what you want to do is you want to forecast, obviously. The other is the stock price. So you want to take the stock price and divide it by the earnings per share. And that's called the PE multiple. Or it's also called the price to earnings multiple. And if I know what the PE multiple is, or what the PE multiple is gonna be, or I know what the PE multiples are for my peer group or direct competitors, I can apply that PE multiple to my earnings per share to get the value of the stock. If I know what the multiples are for the firms that just sold, I can multiply that by my EBITDA or my earnings, and I can get the value of the company. So the multiple approach, the perpetuity model is extremely simplistic. This is going to be your conservative approach. The Gordon growth is also conservative, but it does at least include a growth component to the valuation, which makes it somewhat useful. But the multiple approach is really the number one valuation method used by most venture capitalists, investment bankers, and securities analysts to come up with intrinsic values for not only the firms, the target firms, but also to come up with the stock values. And then what they'll do is they'll compare their valuations to the current sales price of the company or the current stock price. And if their valuations are higher than the current sales price or the current stock price, they're going to buy the company or they're going to buy the stock, because the values that they're coming up with are higher than the current stock price or what they can buy the company for. So that tells them the decision. If it's the other way around, if the valuation is, or the stock price is under the intrinsic value, then they're going to sell or not buy the company because the value is less than what it's currently selling for. So it doesn't make sense to buy it. They'll wait for the prices to come down. All right. Any questions on the multiple approach? Okay. There's a couple other ways of getting multiples. These are one way of doing it. The other way of getting the multiple is I can take 1 divided by I to get a multiple. So 1 divided by the discount rate is going to give me a multiple. It's going to give me the same value as the perpetuity. So instead of taking the cash flow divided by the discount rate, you can take the cash flow and multiply it by 1 divided by the discount rate. So this converts the perpetuity model into a multiple model. And I can do the same thing with 1 divided by I minus G. I get a multiple, multiply it by the cash flow, my value is going to be the same as the Gordon growth. Okay, so most investment analysts think in multiple terms as opposed to perpetuity or Gordon growth, but they know that they can get the same answers by using these mathematical transformations. So the multiple approach is really the most important approach. Okay, any questions on that?
No.
No? Okay, cool. And then I'm going to take this down again. This is is very Buddhist. You know, you write stuff up there and then you just erase it. And you've been doing a lot of this work, you know, in your homeworks and in your extra credits and, you know, the last part of the exam. So you should be fairly comfortable with these methodologies. And then the last evaluation method is the discounted cash flow, or what it's called the DCF method, or DCF. And what the DCF, or the discounted cash flow method, gives you is the present value of the cash flows, because you're going to discount the cash flows back to the present. And that's the present value using DCF. And that model is the sum of the future cash flows. I'll do a quick example of this. So you have the cash flows in the future, and then you got to discount those cash flows back. Right? So this is the present value of the future cash flows. But then you got to take into consideration the terminal value. So this is going to be the selling price or value of the company, you know, or the share. So this is actually what you're going to sell it for at the end of the period, of the last period of your holding period. Okay. So I can do an example. I'll show you an example of this. So let's do a 2-year example. 2-year. I'm gonna buy the company and hold it for 2 years and then flip it, or I'm gonna buy a share and I'm gonna hold it for 2 years. And I'm gonna flip it, or I'm gonna buy a piece of real estate. I'm gonna redevelop it and I'm gonna flip it in 2 years. So to get the present value of the DCF, I'm going to get the cash flow for next year. And again, this cash flow is going to be I take this year's cash flow and I'm going to grow it out at some rate to get the first year in the holding period's cash flow. Then I'm going to take 1 plus I to the 1, right? Then I'm going to do cash flow T plus 2, 1 plus I to the 2. Got it. So now I have the cash flows. Now I got to come up with the terminal value. Okay. So the terminal value is, I probably grew these cash flows out. 1 plus G. 1 plus G. So if I was growing out at 10%, this would be 1.1. This would be 1.1, right? So I'm growing it out. Then what I need to do to get the terminal value, I need to grow this. Remember, it's a 2-year holding period, but I have to grow this cash flow out 1 more year. Okay. So it's going to be CFO T plus 3. And then what I'm going to do is I could either divide it by I to get the terminal value. I can divide it by I minus G if I think that the cash flows are going to grow at a constant rate forever to get the terminal value. Or I can multiply this by some multiple to get the terminal value. So once I get the terminal value, I'm going to divide it by 1 plus I to the second power, and then I'm going to discount that and then sum up all of the discounted cash flows to get the present value using the discounted cash flow method. So that the tricky part in the DCF method is you have to remember that you need to grow out the last cash flow in your holding period. You got to grow it out one more year and then calculate the terminal value and divide it by the discount factor for the last year, and then sum it all together to get the present value. So that answers that question. The valuation methods you could use for the terminal value, you could use the perpetuity, you could use the Gordon growth, you could use the multiple to do it. And I think that's it. Do you guys have any questions on that?
No.
Okay, cool.
No.
Okay, cool. And then I've already given you the solutions to the questions in the back here. For the bond price for 8.1, use the bond model, the annuity model to do the calculation. This yield to maturity calculation, this problem right here, the secret to that one is right here. You can see that the price of the bond, right there, the price of the bond is trading at a discount, okay? So that basically means that the coupon interest rate is lower than the market interest rate. So if the coupon rate is lower than the market rate, then the bond trades at a discount. So you know right here that the coupon rate is 6%. So you know that the market interest rate or the yield to maturity has got to be higher than 6%. And actually the solution here, if you were to calculate the value of the bond using 7%, 8%, 9%, 10%, once you get to 10%, you're going to get to that price right there. So what you'll be able to do is to figure out, the first step is, well, is the bond trading at a premium, at par, or a discount? If it's trading at a discount, then the market interest rate or the yield maturity has to be higher than the coupon interest rate. If it's trading at $1,000, then the coupon rate and the yield to maturity or the market interest rate is the same. If the bond is trading above $1,000, trading at a premium, then you know that the coupon interest rate has got to be higher than the current market rate. So that's just the logic, and that was basically that exercise right there. And then the rest of the problems are pretty self-explanatory because I gave you the solutions to be able to at least practice, you know, how to solve these problems. Okay. Do you guys have any questions or anything?
No, not really.
Yeah. Okay. Cool. And then what I'll do is on Thursday, I'll show you the stockcharts.com technical analysis. And then what I'll do is I'll start working through some of the midterm problems, but you have a lot of those videos already too, so you could start moving ahead. And then my lectures will just, reinforce, a lot of the stuff that you've already been going through. Okay?
Cool.
Awesome.
Is that cool?
Yes.
Very cool.
Is this
Perfect.
good?
Thanks so much.
Yeah, just let me know if I need to tweak anything, or if something's not working, or I'm making you work too hard, or just let me know. And I promise you I'll get to your stuff. I just didn't know it was going to take so long to get through all that stuff. But I'll keep you in the loop on everything. We still got plenty of time for all of us to get A's in the class.
Cool.
Okay.
Thank you.
Yeah, you're welcome. And then let me know if you guys.
Thank you.
Yeah, let me know if you guys want to get together on Zoom or anything like that,
Okay, cool.
and I'll make some time for you guys.
Thank you.
All right.
Thank you, Professor.
You guys are awesome. Thank you. You're welcome.
See you later.
Okay, Michael, Samantha,
See you,
Ania,
Professor.
Daniel, Jade, Brandon, Michael, Mo, Jose, Izzy, Marquez, China. Thanks for coming.
Thank you.
Thanks for coming,
Thank you.
Jade. Good to
Thank
see
you,
you.
Dr. Susan.
Thank you.
You guys are awesome. Thank you for your help. Let me know how I can help. If anybody wants to stay online, I'll take an office hour.
I just have a quick question, Professor.
Yeah, Daniel.
So the solutions to the midterm are on the videos, right? On the video
Yeah.
lectures that you.
Yeah, totally. Yeah, I walked through all the problems.
Okay.
Yeah.
Yeah. I had some. Is there? I need to talk to you about something.
Okay.
That's with family.
Yeah. You can.
Yeah.
Just give me a call.
I can tell you right now, it's a
Okay.
fact. But my uncle actually tested positive for COVID-19. So.
Is he? How's he
Yeah.
feeling? How's he?
He's not doing so well.
Really?
He's in critical condition right now.
How old is he?
He's like in his 50s,
Oh, no kidding.
like mid to late 50s.
Does he have any autoimmune or diabetes or anything like that?
He's on I think he's on dialysis because I think his lung collapsed, or like his immune system is kind of weak. But
And where does he
yeah,
live?
he lives in Orange County,
Does he?
down in Fulton. So
They have some good medical facilities down there.
oh yeah, they do. So
Yeah, I'm sorry to hear that.
yeah, but I'm not saying it as an excuse for just not getting work done. But,
No, don't worry about it. No.
I'm just
Yeah, I'm not worried about you, Daniel. You're awesome. You're
thanks,
a great
Professor.
student. Yeah, and we have plenty of time. We have plenty of time. So take the time that you need to take care of your family and take care of yourself, and we'll work together.
All right, thanks.
Okay. You're welcome.
All right, see you later.
My pleasure. Good luck. Jade, did you have a question? No. Okay. All right.
actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
It's 2 p.m. in New York, 7 p.m. in London. I'm Scarlett Fu, anchoring from home. My co-host, Romain Bostic, will be joining us shortly. We just need to sort out some technical issues. But looking at the markets right now, we've just come up off our lows of the day. And to the extent that there is any economic data out there, it does look like things fell a little bit less than expected when it comes to consumer confidence and Chicago PMI. So to that end, I want to bring in now Abigail Doolittle to give us more of a read on today's market action. Abigail?
Thanks, Scarlett. And yeah, you know, it's a really extraordinary day within an extraordinary month and quarter. Lots of whipsaws here on the day, starting out lower with greater than 1% declines, then up 0.5% not so long ago, as you were just implying, down sharply, down more than 1%. But take a look at that NASDAQ, about flat, really fluctuating all over the map, a representation of what we've been seeing. This represents uncertainty, the same volatility that we've had over the last 6 weeks or so, seeing on a micro level here. And before we take a look at the brutal quarter and month numbers, let's take a look at what's been happening over the last 6 days. Because, of course, right now we're in this rebound rally, even though we're down a bit on the day. Over the last 6 days, up more than 15%, the best 6 days since 2008. Now, this is really a technical rebound rally. The S&P 500 held support off the 200-month moving average. It seems to be holding right now. However, we all know that the to 1979 on record, really pretty extraordinary. The 10-year yield on that big bid for bonds having its biggest fall ever on record going back to 1963, and gold getting a bid. So clearly a big risk-off quarter as the uncertainty around the coronavirus tragedy and what it could mean for the global economy taking a big impact here. But the biggest impact, Scarlett and Romain, oil. Take a look at this year-to-date chart, or basically the first quarter of this year, down 65%, more than 65%, the worst quarter ever. That could be
Is anybody there?
Not just for the economy, but the S&P 500, as we've discussed before. Commodities less liquid than stocks, so they tend to sell off more directly and more quickly. And also, again, a reflection of the demand picture that is shrinking in the world as a result of the coronavirus. Romain and Scarlett, back to you.
All right, Abigail, I'll pick it up. Thank you for that context. And yeah, crude oil having an incredible move down so far this first quarter. All right, let's bring in Mike Regan, who is our senior markets editor for Bloomberg News, to give us a little more context here on how the markets are. Because, Mike, as Abigail was telling us, it's a brutal first quarter. Today looks a little bit more normal. In fact, I was just looking at the Dow. Intraday point swing for the Dow today is only 446 points, which makes it the smallest point swing since February 21st. It feels almost normal. So to that end, are people saying that we've reached the bottom? And how are people determining whether we have or haven't?
Yeah, right, Scarlett. Who would have ever thought we'd consider a almost 500-point swing in the Dow as a normal client day? But it certainly is less volatile than what we saw, especially at the sort of the throes, the really worst days of this bear market. There is sort of a growing course of people that think maybe the bottom has been in. I'm not sure there's 100% confidence in that, but, you know, the problem that a lot of, especially technically minded people have in trying to figure this out is just how unprecedented the speed of the decline has been. On top of that, the potential economic damage and the nature of the damage, the threat to consumer spending and the massive job losses, that's pretty much unprecedented as well. So if you try to go back in history and find, well, the market behaved this way, at this point, and here's what happened. It's almost impossible to do, obviously, just because there's not really any other set of circumstances that line up perfectly with this, or even remotely close to this. And not only the economic damage, but the massive stimulus from both the Fed and the government, the stimulus bill. I think for today, the big question on pretty much everyone's mind is how much of this rebound we've seen over the past week has been sort of driven by rebalancing, by pension funds that are mandated to keep a certain ratio of stocks and bonds in their portfolio, whether it be 60-40 or some other ratio. Through hell or high water, these funds rebalance to those ratios either at the end of the month or at the end of the quarter. So when you see this massive outperformance by bonds compared to stocks that we saw in both the quarter and the month of March, it's natural for there to be some buying pressure in, say, the last week of the month. It wouldn't all come today necessarily. Kevin Price and some others have done a lot of work on this, suggesting that about 5 days before the end of the month is when you really start to see the effect of rebalancing. And sure enough, we've seen this massive rally in stocks, not really major declines in treasuries, but obviously there's buyers that perhaps would overwhelm any selling that would happen from rebalancing in treasuries. So to see this rally kind of fade today, I think everyone needs to be vigilant to figure out, well, how much of this rebound that we saw was the result of rebalancing. Perhaps not all of it, but certainly that impetus, that motivation to buy in the last week of the month was there for a lot of pension funds that are required to do so after such a drastic dispersion between bonds and stocks over the quarter.
Okay, so you make a good case for tactical buying here for why the market rebounded last week. But going forward, when you look at the fundamentals, and of course we're going to get ready for earnings season soon too, and for any kind of anecdotal evidence that companies can offer us to the extent that they're going to really go out on a limb and say very much, what's striking to me is that you really don't hear very much about this idea of a V-shaped recovery anymore. It feels like that narrative is all but gone.
Right. I mean, we haven't even begun to see the major damage that's being done. I mean, we got that first taste of it with the jobless claims last week. We know we're going to see another nasty number there this week. The jobs report for the month of March will be at the end of the week. Everyone knows that's going to be ugly all around. So it's very hard to make, with 100% confidence, make the case that bottom that we saw about a week ago was it, that was the end of the selling. Fundamentally, it's just so many question marks and so many sort of unknowns right now that it's really difficult for fundamental investors to begin with. So if you're a technical investor, the one thing I noticed that was really interesting is, on Bloomberg you can back test something like 40-some sort of textbook technical strategies. And none of these really did that well last year. The simple strategy of buy and hold was the best strategy for 2019 among some 40 strategies that you can back test. But when we did hit that peak, if you start at the peak of February 19th and look at the bear market, many technical strategies signal it was time to get out of the market, either sell or short the market,
right.
And did very well during that downturn. Since we've had the rebound, it's back to buy and hold being the best strategy again. So it's clear that there are these technical strategies, at least in this instance, give you a good idea that you're looking at a falling knife, and to get away from it, the time to come in and catch that knife obviously is not as easy.
Absolutely. Mike Regan, thank you so much, our senior markets editor, and of course you can see Mike's handiwork, his fingerprints, all over the MLive blog on Bloomberg. Now, let's turn now to Bloomberg's First Word and to Mark Crumpton for some headlines. Mark?
Scarlett, thank you. President Trump wants Congress to provide $2 trillion for U.S. infrastructure. In a tweet today, the president said the timing's good for a massive infrastructure bill because interest rates are close to zero. Mr. Trump has long advocated for an infrastructure plan, but has never settled on how to finance it. New York City is getting help from the federal government in the fight against the coronavirus pandemic. FEMA, the Federal Emergency Management Agency, is sending 250 ambulances to New York City, staffed by 500 paramedics and medical technicians to help its fire department respond to an unprecedented number of medical calls. New York City has also reported its first virus death of a person under the age of 18. Some encouraging news from Italy. The number of new coronavirus cases there leveled off today at a 2-week low. Officials say there were about 4,000 infections in the past 24 hours, the same as the previous day. The Italian government's considering extending restrictions through the end of April, with a gradual opening of the country in early May. The European Union's telling its member countries not to forget about human rights as they fight the coronavirus. European Commission President Ursula von der Leyen's comments came a day after Hungary's parliament approved a bill giving the government extraordinary powers with no end date in response to the pandemic. France has also passed a law increasing the prime minister's powers, a move harshly criticized by human rights groups. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett, Romaine?
Thank you so much, Mark. Now, coming up this hour, we'll be speaking with Matthew Wadiak. He is CEO of Cook's Venture to discuss how his company, a chicken supplier, is dealing with consumer demand in these uncertain times. This is Bloomberg. It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets. This is Bloomberg Markets, the close. I'm Scarlett. And Romaine, yay, we got you up and running.
Yeah, finally, Scarlett. You started without me. They couldn't push the show back?
You know, it's
all right, let's get All right, let's get a check-in now of our top calls. These are some of the movers on the back of analyst recommendations today. First up, let's take a look at Cirrus Logic, the big Apple supplier here, upgraded 2 notches over at Bank of America to buy from underperform. The analyst citing the potential of Apple's upcoming iPhone. Cirrus gets more than 80% of its revenue from Apple. You can see what the shares here are doing on the day. Next up, let's take a look at Snap. Snap, the price target there lowered to $12 from $18 over at SunTrust. The analyst citing weaker ad demand as a result of the slowdown in ad spending because of the COVID-19 coronavirus pandemic. The shares of Snap today moving. And finally, let's take a look at Tesla. Tesla's price target lowered over at JMP. The analysts now expecting lower production and delivery activity for 2020. The shares on the day. All right, and those are some of your top calls for the day. Scarlett?
All right, the coronavirus pandemic taking a heavy economic toll on the metro New York region, which has become the epicenter of the outbreak here in the U.S. The New York Fed is out with some new research on what's called the tri-state impact. And we're joined now by one of the authors of that study. His name is Jason Graham. He's research officer for the Federal Reserve Bank of New York. We're also joined by Mike McKee, Bloomberg's international economics and policy correspondent. Jason, let me start with you because we are all desperate for some kind of current read on the economic impact from the virus and the lockdown for all but essential workers. You've gathered some new data. What story does it tell?
Hi, Scarlett. Well, what we found is we do these two business surveys every month, and the surveys in the field the first 10 days of the month, and we have a survey of manufacturing firms and service firms. But since things really didn't start to kind of really fall apart until later in the month, we decided to do a quick survey from March 20th to the 24th. And what we found was that there was a huge impact.
How you doing, Richard?
Businesses in the region. I think
Good.
probably the most important.
And did you want to go over some stuff after class today?
About a third of manufacturers and half of service
Okay, cool.
said they had implemented at least a partial temporary shutdown.
Yeah, I just needed like bullet point. I mean, I think we share on file on the bullet points for oil and gold.
Okay.
I just want.
Yeah, we'll check it out together.
40% of service firms and 30% of manufacturers said they may have made at least some staff reductions.
Because I mean, with all this nonsense, like oil's
So
just
Jason,
gonna go up, right?
we're going through this
At some
data,
point.
obviously you're talking to these businesses, you're getting this information
It's not a
out of
good
these
like
businesses.
prediction.
When they give you this data and they talk to you sort of about what their concerns are.
Yeah, I mean, it's going to drop below $20, but at some point it's going to go back up again.
Yeah.
It's just the Russians and the Saudis are crazy.
Yeah, and that's basically my bullet point. We're like Russian, Saudi,
People have said the
COVID-19.
virus will
Yeah.
dictate, when things will come back,
Like,
and how much things will come
And
back.
then my graphs
so
were
we thought
one
it
was
was a
the
little
ETF,
much
or
to
they're both
sort of
ETFs, the Saudi
them
oil,
under.
but I'm open to whatever other ones I can use.
Okay, cool.
I just applied for Cole's summer internship. It took me like 35 seconds.
Where?
Like Cole's for a store management intern
Yeah. Yeah.
for the summer.
Yeah.
It took like 45 seconds
To apply or to get the job?
to apply, like fully apply.
Yeah, I bet they're dying for people.
Well, Enterprise fully suspended. I had a second interview for a summer internship, so they fully suspended. Target is still doing phone stuff.
Yeah.
I was Southern Glazer Wine and Spirits fully suspended.
Oh shit.
Moving forward, just for now, and then both financial institutions I talked to both suspended. University Credit Union.
And there was no way you could tell them you could work remote or anything like that?
Yeah, I did.
Did you?
And they were,
Okay.
Like overall, they were just suspending all recruitment, like for the time being.
Yeah.
So I'm still keeping in contact. I'm dropping once a month. I'll drop the once a month email to the contact. Hey, checking in. But yeah.
Well, good luck with all that stuff.
Thanks.
President Trump tweeting that he wants a $2 trillion infrastructure package. This is part of the next round of stimulus to sort of underpin the economy here as we deal with the COVID-19 coronavirus. Joining us right now to talk a little bit more about what we know and what we don't know, Alex Wayne, of course, he leads our White House coverage down there in Washington. All right, Alex, we've talked about infrastructure before, I believe, with this administration. Infrastructure Week, I believe, was a thing with this administration. What exactly is the plan now with this administration?
Who knew infrastructure week? We're not aware of any actual plan. We're aware of Trump tweeted today that he wants a $2 trillion infrastructure plan. I think what he's probably figuring is just speculation now. The last time he talked about an infrastructure plan with Congress, negotiations fell apart because Democrats told him you need to figure out how to pay for it. Trump didn't want to because that would mean proposing a tax increase probably, and so it flopped. That was in May. So now he just signed a $2 trillion stimulus bill related to coronavirus that has practically no pay-fors of any kind in it. It's just deficit spending. And I think he is thinking that he might be able to get an infrastructure bill through Congress during this crisis that isn't paid for. It doesn't have any tax increases or any kind of fees or tolls or anything like that. Just deficit spending on infrastructure.
Well, Alex, given the political climate then, and how fast we got that $2 trillion Phase 3 relief package out the door, is the political climate maybe a little bit different this time around? We're maybe putting in an infrastructure bill of this magnitude without it being paid for might actually fly through Congress.
I think it is more favorable for a bill like this. Yeah, definitely. We all saw how quickly the $2 trillion bill was last week. Republicans really didn't put up much resistance. There were very few complaints about the bill not being paid for. Now that might change with an infrastructure bill. Republicans in the past have demanded that an infrastructure bill do stuff like include the private sector, so you can have toll roads and fees for airports or whatever. They might bring up those objections again for an attempt to pass an infrastructure bill. But there's definitely appetite on both sides of the aisle for another stimulus measure related to coronavirus. Everybody's looking at the numbers, the job numbers, and all the signs that are pointing toward a really bad recession from the coronavirus. And Congress is very eager to pour more money into the economy.
Okay, Alex, that makes sense, but at the same time, no one is actually in Washington right now. I believe both chambers of Congress are on recess. Very quickly here, when are they due to come back?
I believe they are not scheduled to hold any votes until April 20th. But that doesn't mean that their aides aren't here. They've got people, of course, who work for them in Washington who are busy probably drafting up the next proposals for the next round of stimulus. Nancy Pelosi said yesterday she's got some things in mind. It would probably be a lot of stuff recycled from the House stimulus proposal last week that was rejected by the Senate and by the White House. But trust me, there are people hard at work in Washington right now drafting up that stimulus.
All right. Thank you so much, Alex Wayne, in our Bloomberg News Washington Bureau. From New York, this is Bloomberg. Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. Scarlet Booth here in my home. This is Bloomberg Markets The Close. Now, demand for groceries is higher than ever, but food supply chains, as we know, are disrupted due to measures to slow the spread of coronavirus. So joining us now is Matthew Wadiak. He is CEO and founder of Cook's Venture, which is a chicken supplier to consumers. And prior to that, Matthew founded and served as COO of Blue Apron, which many of our viewers are familiar with, a meal kit preparation company. Matthew, let me start first with this idea that we understand that there's plenty of inventory of food. There's agricultural products. There's no shortage of that, but there's a lot of concern that workers are now getting sick and the distribution of this food is problematic. What have you seen on your end at Cook's Venture?
Well, we're staying in close contact with other leaders in the industry and are communicating what are the best safety protocols to follow for our employees and for the folks that have to manage supply chain. Obviously, essential services mean that we have to eat and we have to continue to live as a society. So following best practices is really at the forefront of everyone's mind right now. So making sure that food companies are following protocols to do extra sanitation shifts, that we're giving employees extra protective equipment, that we're doing more laundry than we usually would, more frequently, more cleaning, and more protective gear. And most food companies across the board are also additionally providing pay incentives for their employees to make sure that our employees feel, and other folks in the industry as a standard feel like
we'll get started in a second.
Their work is valuable. We hear a lot about the medical community, and there are truly heroes emerging on a daily basis, but also those of us who are continuing to supply Americans and folks around the world with food are equally contributing to that heroism.
And Matthew, full disclosure, by the way, I just ordered 2 heirloom chickens for $40 and got an email that it's being shipped right now. I read a little bit about how Amazon got a sense of the flood of demand that was coming back in January, so it had a little bit of time to prepare and brace itself for the coming onslaught. What was your lead time? Were you able to prepare for this surge in demand in any way?
Well, one of the issues in the agricultural community, obviously, like a company that strictly just does fulfillment like Amazon is able to ramp up staffing and prepare their facilities for an influx. But when you're in the agricultural commodities industry and when you're dealing with agricultural products, your lead time to produce an animal from an egg to an animal that you can then harvest is, 60 to 90 days. So in livestock, the timeline becomes longer and longer and longer the bigger the animals get. So it's almost impossible to predict and forecast for things like global pandemic due to the lead time associated with growing, live animals. So, and that's something to consider as we move into, a different kind of era in the way that we think about food security in our supply chain, ensuring that we can have preventative measures in place in the future to keep these things from happening. And one of the main issues that we know through supply chain is that the conventional breeds of livestock today are disease vectors. And having alternative genetics, as we do, we only grow heirloom chickens. I'm sure you just learned that as you ordered them on our website. But having alternative breeds that have stronger immune systems, greater health, and more access to better livelihood prevents actually the endemic spread of disease between species.
So Matt, there is a short-term issue and a long-term issue here. On the short term, we did actually see the USDA relax some of the grading guidelines on eggs, presumably to prevent or at least to stem some of the price increases that consumers have seen. When you see the USDA and other regulators start to relax rules like this, even though it's done with good intentions, does that worry you, or are you encouraged by the fact that they're doing it?
Well, most of what the USDA has done hasn't relaxed the standard of overall inspections. It's mostly labeling related. So, for example, a medium egg versus a large egg, or what might have been designated previously for food service versus retail. I don't think from a consumer transparency thing, it's something that we want to do long term, but understanding that people need to go to the store and find, that they can buy, a piece of meat or eggs or cheese or things that are generally overseen by the USDA is important. So I think so far the guidelines that have been put in place are reasonable.
so long as we get back to the norm, pretty shortly.
All right, and then on the long-term issue here, Matt, with regards to supply chain and really just the idea of being able to get your food out the door, and this is probably less a question for your business and more for some of the folks, agriculture farmers. What about the labor issues that we could potentially deal with? We've heard from a lot of growers that they're already starting to worry about the April harvesting season because a lot of the foreign-born workers that would normally come into this country are effectively restricted because of the COVID-19 crackdown.
Yeah, I mean, it's an interesting consideration, and when we talk about supply chain, often we mix metaphors and we talk about diversified vegetable supply chain and the kind of things that you eat in a salad, as a side dish to a dinner plate. And then of course there's a big agricultural community surrounding livestock feed and feed that's grown in grain form for human consumption and animal consumption. And I think in terms of the macro supply chain, which involves mostly row crops like wheat, corn, soy, and alternative crops, we should be secure in terms of labor. Most of that is as most of us know, for better or for worse, automated processes, and it's representative of 97% of America's agriculture in terms of caloric density. The 3% of agricultural goods that we're really talking about with that statement involve fruits, nuts, harvestable lettuces, stuff that you buy in the produce aisle of the grocery store. And there is some real concern around that because, look, if workers can't get back to work and manage plantings and manage, the upcoming positioning of those crops for vegetable consumption, then we could have shortages afoot ahead of us.
Hello, everybody. How are you today? Good. Hey, Brandon, where are you?
No.
Oh, is that just a backdrop? I thought maybe you were down on the soccer field or something.
Man, I wish.
What is that? Is that the what is that? The Sharks? Not the Shark Stadium, but is that the Earthquakes?
No, this is Midlothian Hearts. It's a team in Scotland.
Oh, nice, awesome.
Yeah.
Cool. Are they soccer or rugby?
Soccer. I got the privilege to go over there and just walk on the stadium. Got to go on the field. So
nice, awesome. Yeah. Good to see you. How's Rich and Grant and Bosco and Diana, and how are you guys doing?
Doing good.
Good. How's Emily and Catherine and William, Hannah and Nicholas and Brian?
Good.
Good.
Awesome. And how's Ronnie and Cooper and Landon and Trevor, Matthew?
Fantastic.
Yeah, good. Everybody hanging in there, everybody safe.
Living the dream.
Yeah. You and me both, buddy. Oh, shoot. You guys got any questions or anything to start off on?
I think I'm good. Thank you.
Yeah, okay. And then you guys are getting my my emails and my announcements and stuff?
yeah.
Yeah, I've been.
Okay, cool. And then I still got to go through your stuff. So if you can, continue to upload, your stuff in here, and then I'll take I'll spend some more time. We have spring break next week, so I'm sure I'll have a lot more time to go through all this stuff and give you guys the feedback that you need. Okay.
Okay.
Yeah, and then you guys can continue to move forward on the extra credit, the midterm. The midterm review videos are already up there for you to take a look at. I'll go over the midterms or the midterm, but you can go ahead and start, writing up the, the answers to the problems. And then I'll be around. I sent you my schedule. so I can meet with you guys on, via Zoom, one-on-one, if you'd like me to go through your stuff with you, and then I'll be around all next week, to go over anything that you guys may want to go over. So you can just schedule an appointment with me. We can do a quick Zoom call. Did I lose you all?
No, that's awesome.
Okay.
That sounds good.
Okay, cool. And then, do you guys have any? Sorry, I forgot to share my screen. This stuff in here. Do you guys have any preference on what bank you want to analyze at the end of the semester here after the spring break? Is it, Goldman Sachs, B of A, Wells Fargo, J.P. Morgan? Any preference?
I don't know. I think Goldman, maybe.
Okay, I got 1 out of 23. Excellent. Anybody else?
Bank of America.
Okay,
Wells
B of A.
Fargo.
Wells Fargo, got it.
B of A.
B of A. Anybody else?
Wells Fargo.
Wells Fargo.
Okay, 2 Wells Fargo, 2 B of A, 1 Goldman. Keep going.
First Republic Bank.
First Republic, they are publicly traded, and they're a really good they're a really good company too. Should we do First Republic since they're here and they hire our students? I hear birds. I hear the chirping of birds.
Sorry, that's me. I'm like, my window's open. Sorry.
No, that's good. I mean, the birds were the only ones who were actually responding to my question. So I got 1 First Republic, 1 Goldman, 2 B of A, 2 Wells. So that's basically 6 people out of 23.
I think if it's all split, it's probably like a poll.
Like Goldman, J.P. Morgan, or like Citi.
Okay. So I've never done the poll. Oh shit, wrong one. Why don't you just send it to me in chat and then I'll take a look at it. If I don't get, any definitive numbers, I'll pick it myself.
Just send the one we're voting for in the chat.
I have 2 B of A, 2 Wells Fargo, 1 First Republic, and I got 1 Goldman Sachs. So if you can just type in what you want, I'll count them up. So you guys want to do Wells Fargo?
Yeah.
All right.
Like it.
Yeah.
Okay, you're just gonna have to be. It's gonna be a little bit more challenging because of the PR issues that it's been going over. So we'll do Wells Fargo, but I just want to warn you that because of their lawsuits and stuff like that, their earnings are going to be kind of choppy. But we can do it, but it's just going to be a little bit more challenging.
Whoa. Why don't we reassess then, maybe?
I'd still vote First Republic Bank.
Yeah, maybe First Republic, because we can work there.
Yeah, I mean they hire a lot from St. Mary's, USF, San Francisco State, would be a strategic move on your part to do First Republic?
I like First Republic. I think that's a good idea.
Okay.
Yeah,
I think
switch over to First Republic.
yeah, I think that's a smart. I think it's a smart move on your part to do it. Okay. So let's do First Republic. All right, excellent. And then what I'm going to do today is I'm going to finish off the quiz. Some of you have already finished it by going through the videos, but I'm going to go through it. I would go ahead and start working on deliverable 2 with the homeworks, the extra credit, the memos, the midterm is already had some review videos up there that you can use to start on that, and then I'll follow you guys behind and go through the go through maybe like a couple problems every class to kind of get through it, but it takes a while to get through the problems, so I would do the best you can to lay it all out, go ahead and do it, and then I can follow up behind it to make sure that the methodology is done correctly. Okay? Okay, cool. So, yeah. And then I got, I'm going to turn this thing around. So I already got I got the quiz, and we should have left off with the quiz. On my side was that we already did the modern portfolio theory piece. So we'll do the trades, we'll do the technical analysis, and then we'll do the intrinsic valuation, and then I'll go through the some of the problems with you on some of the key points from the problems at the back, and then you guys should be in really good shape. Okay? Okay. Thank you. How's that look? Can you see that?
Yeah, we can see it.
Okay, cool. Let me know if you need me to move it or something. Okay. And then what I'll do is I'm going to start over. This is a garage school. Okay, let's do it. Okay. Can you see that?
Yeah.
Okay. Okay, cool. So let's do the derivative trades. Okay, and you should be somewhat familiar with those from the memos. And then, did I go over the different types of derivatives? Like forwards and futures and call options and put options.
No, I don't think so.
Okay, so I'll do that on Thursday. Okay, and then let me know when you guys are ready to do some chapter presentations. Okay. Okay, how's that look? Okay, good. So the derivative trades, there are two sets of trades. When prices are going up and when prices are going down. And you're going to have the indexes. Okay, you're going to have the ETFs. And you're going to have the stocks. Okay, got it. And then for the index, when you think the price is going to go up, when you're forecasting prices going up, you're going to buy forwards, you're going to buy futures, you're going to buy calls on futures, and you're going to write puts on. Got it. Okay. And then remember, for the ETFs and the stocks, they're the same thing. So for the ETFs, you're going to buy. You're going to buy a margin. You're going to buy calls. And you're going to write puts. Got it. And it's the same thing for the stocks too. So you're going to buy. Margin. Buy calls. And you're going to write puts. Got it. Okay. And then for, if you're thinking that prices are going to go down, remember from the lecture that I did last Thursday on the modern portfolio theory, that these trades here could be used as tools to hedge off the market risk embedded in your portfolio. And when you apply these, it also bows out the efficient frontier. Yes, it's going to reduce the expected return on the portfolio, but it reduces the standard deviation even more, which increases the risk-adjusted rate of return. These trades also lock in your net expected returns. So here you're going to write forwards. You're going to write futures. You're going to write calls, futures, and you're going to buy puts on futures. Okay, got it. And then for the ETFs and the stocks, you're not gonna sell on margin. Some people put that up there. You're gonna sell short. Okay, so you're gonna sell short. You're going to write calls, and you're gonna buy puts. Got it. Sell. Short, write calls, write puts. Got it. Okay. And that's it. All right. Any questions on that? Anybody got any questions? You okay?
No.
Okay. And then the next question is the technical analysis. All right. So the technical analysis, this is how I write it up. Okay, so this is the RSI up here. This is the trading volume right here, and this is the MACD. Okay, so if you go to stockcharts.com and you put in a ticker APL, that's the chart you're going to see, and I'll show that to you on Thursday. But this is how when you're doing technical analysis, what you're learning in this class is mostly fundamental analysis, particularly fundamental securities analysis. This is technical analysis. This is what traders who trade stocks normally use. And when they look at a stock, they're looking at the trading patterns of the stock prices, not only in the most recent period, but over time, to try to get an indicator of the behavior of the stock price and to see where they think that the stock price is going to go based on the technical analysis. So stock price behaviors in most cases, look something like this. So that could be a stock price pattern, which basically you see that a lot because stock price patterns reoccur, and if you know what the pattern is, then you know how the behavior of the price, and you know how to trade the stock. First, before I get into this, there are different types of technical trading theories. Techniques, systems. One is Dow theory is one. Momentum trading. Usually, if stock prices have been in a strong upward trend, they usually continue in an upward trend. If they're in a strong downward trend, they usually continue in a downward trend. If they were trading sideways and they started to move up, they're probably going to continue to go up. And if they traded sideways and they start to move down, they'll probably continue to go down. So momentum in the stock price. Usually helps to predict where the stock price is going to go. The other is moving average crossover systems. I can take a 50-day moving average and then calculate the 10-day and the 30-day. And then when the 10-day crosses the 50 and the 30-day crosses the 50, I sell it. And then if the 10-day crosses the 50 and the 30-day crosses the 50, then I buy the stock. So just based off of the moving averages, I can come up with buy-sell trades. And actually, this is a very profitable system. We use this a lot in my investments class. And then I could use regression techniques to forecast the stock price or earnings, growth rates based on factors. So I can use a regression model. I can use exponential smoothing, which you hopefully learned in your quantitative quant class. And I could use the Wyckoff method, which is he was a mathematician and came up with a system to that a lot of technical traders have been using to trade off of. This whole system, this whole theory, technical securities analysis, you can get a concentration in it if you wanted to at Golden Gate University, which is where a lot of the traders go to get trained. And there's the Institute of Finance in New York that also does the exact same thing. So those are the two top places to train securities analysts in technical securities analysis as opposed to fundamental securities analysis. I like to use both fundamental and technical to do a better job at placing the trades. There's more winners than losers in the trades. So those are the theories, and this is the technique. So the first thing when I'm analyzing a chart, I notice that the stock price looks like it's bottoming right here, and it doesn't seem to want to go below this level. So that, I draw a line, and that becomes the support line. That's the support for the stock price. And you can also see right up here that the stock price doesn't want to go any higher right here. So that sets the resistance. So that's your resistance line. And stocks will trade within these support and resistance lines until new information comes out on the stock that would cause it to either break out to the upside or break out to the downside. And as you can see, that right here, the stock price did break out to the upside and then started to form another support right here where the resistance line was. And then this is your breakout to the upside. Oops. So that's your breakout to the upside right there. And then it forms another support. And it looks like it even formed a little mini resistance right there before it really broke out to the upside. Let me step back a little. This area right here, when the stock price is trading, you know, between the support and the resistance, and seems like it's trapped. It is trapped. It's trapped in what is called a trading range. And if you listen to Bloomberg and other financial news, they use these terminologies too. They use this language. This area in here is also called a sideways pattern because the stock price is just trading sideways. So this is also a sideways pattern. It's also called the accumulation phase. And it's also called the consolidation phase. So what's happening is all of the information going into the stock price is accumulating and consolidating in this range. It's trading sideways and showing a sideways pattern. So basically the stock is dead in the water. It's not doing anything. It's waiting for new information to come to it, to shock it, either to the upside or the downside. If there's no information or any good information about the company, it could trade in that range for quite some time. Then you get the breakout to the upside. And then you could see the stock price goes up, comes down, and it looks like it's forming another support right here. And it looks like it's forming a resistance up there too, but it peaks right here. This is called the peak. This is all called the head. This right here, these two right here are shoulders. And then this formation right here is called the head and shoulders pattern, or head and shoulders formation. That recurs a lot in stock patterns. So if I know that it's forming a head and shoulders, I know it's going to run. It's going to correct, sell there, buy here, sell there, buy back, sell there, buy back here potentially. So it's a formation that you can use to spot trends. And then as you can see right here, these were breakouts here to the upside. Here's a breakout to the downside. You can see that the stock price dropped, started to form another support back where the resistance was. Looks like it broke out to the downside there. And then came down here. Looks like it formed a support where the support was months ago. And then it broke out to the downside again right there. This chart looks a lot like Yahoo, okay, the Yahoo stock price. Yahoo was in for a long time, Yahoo, since, I would say since 2000 or 1998 through like 2007 was in a pretty strong upward trend. This is your upward trend. And then the stock started to go into a downward trend. And then it hit a couple mini supports before the stock price really went down. But the stock price didn't collapse because people thought that the stock actually had value. And eventually the stock was bought out by another company and taken out through a mergers and acquisitions. Okay, any questions on the technical analysis?
What was the thing you wrote to the far right?
Right here?
A bit more up.
Yeah,
Yeah, that one.
yeah, this is a shoulder. These are the shoulders. This is the head, so this is higher than the shoulders peak. It's called the head and shoulders pattern or the head and shoulders formation.
Okay, thanks.
Yeah, you're welcome.
What would the
I'm sorry. What'd you say, Rich?
What would the RSI and the volume look like?
Yeah, I'll go through that. Thanks for reminding me. So here, yeah, what'd you say?
Would you mind sending a picture of this in the thing? It's just because the camera is very blurry, so I can't see everything.
Yeah, and I think there's some pictures, on the course website too, and the video too. But I'll send you the pictures.
Thank you.
Okay. And then the RSI and the MACD indicators are also momentum indicators. So what you'll see is that, see how the stock price is moving sideways here? So the MACD will be basically flat. And so will the RSI during these periods. But when the stock price starts to move up, the MACD moves up and the RSI moves up too. And then when the stock price starts to come down, the RSI and the MACD also starts to move down too. So they're momentum indicators. So if I see, like recently, the stock prices went down pretty heavily over the last couple weeks, except for last week they did pretty well. You'll see that the MACD and the RSIs, bottomed out, and then when the stock market started to go up, you see them start to point in that direction. So a lot of traders, once they see the RSI and the MACD start to move up, they start to place their trades, and it creates more momentum in the stock and pulls the stock prices up even higher. The volume chart, which you'll see, is it's trading volume. So people buy and sell stocks, okay? And then you're looking at the total volume of trades in the stock for that day. So when the stock prices go up, there's a lot more buying. When the stock prices go down, there could be more buying too. So what you'll see is these patterns of volume, and especially when the stock price breaks out to the upside, you'll see really high buying volume. And then as the stock price consolidates, the volume will drop a little bit. And then when people sell off the stock, you'll see really high volume. Again, consolidate, really high in the sales. So the volume is also an indicator of either a lot of buying or a lot of selling, but if there's not a lot of volume, then the stock price isn't really going to go anywhere. Okay, so the volume can also be an indicator of either selling momentum or buying momentum in the stock. Okay, thanks, Rich, for asking that question, because I forgot to do that.
Didn't know if I didn't know if you had done it yet or not.
No, I didn't do it yet. Okay, any questions on that? Okay, I think that answers that. And then the next is the valuation methods. Okay, got it. Okay, so I'm going to erase this if that's okay with everybody. So I'm going to need some room to do the valuation stuff. Okay, so the next one is going to be the intrinsic valuations. And there's 4 methodologies, and I'll go through those. So the first is the perpetuity model. And what you're calculating is the value you're calculating the intrinsic value. And you could be using this method for the to value a company, or value a stock, or value a piece of real estate. It's a very simple model. And it basically states that the cash flow so that's CFO is what it is, CFO. T plus 1, so it's next year's cash flow, which you're forecasting, is going to be divided by some discount rate. And you can use, for discount rates, you can use expected or required rates of return. Would be 1. You could use a weighted average cost of capital. You could use the capital asset pricing model that comes up with the cost or the expected return on the equity. And we know that the CAPM is the risk-free rate plus the beta times the return on the market minus the risk-free rate. So that could be the discount rate that you're using. The assumption for the perpetuity model is that these cash flows that you're receiving are going to remain flat forever into the future. So the valuation assumes that these cash flows are going to remain flat or constant forever. So it's just next year's cash flow divided by the discount rate is going to give you the value using the perpetuity model. The Gordon growth the Gordon growth model, or the constant growth model, is basically the perpetuity model. Where you're taking the cash flow for t plus 1, taking the same discount rate, but you're subtracting out the growth rate, the constant growth rate in the cash flow. That's going to grow at a constant rate forever. So it's a very simple model, but it's different from the perpetuity because it assumes growth. And obviously, if the growth rate goes up, then the valuation also goes up. And if the growth goes down, the valuation goes down. Okay, the next method is the multiple approach. Okay, and the multiple approach, the value using the multiple is the cash flow, same one, t plus 1, times the multiple, t plus 1. It's going to give you the value. And actually all of these values are future values, because you're using future cash flows. Now the question is, what's the multiple? Okay, and what's the cash flows? So the cash flows, I can use, if I'm trying to value a company, I can use earnings before interest, taxes, depreciation, and amortization, EBITDA, which is also called free cash flow. Got it. I can also use earnings from the company. And if I'm valuing a piece of real estate, I could use net operating income, or NOI. So let's say I'm trying to value a company. Maybe it's my company or another company that I want to buy. If I know my cash flows for my company for next year, or I forecast what the cash flows are going to be for the company I want to buy, that's all I have to do is multiply the multiple by those future cash flows to get the value of the company. So what we do when we're buying companies is we go out and we find multiples. So we'll go find we'll go out and find the sales price for similar companies that have been sold over the last year. And we'll take that sales price and divide it by the EBITDA to get the EBITDA multiple. Or I could use earnings to get the earnings multiple to value the company. I can also, this is the value of the company. If I wanted to value the stock price, the share of the company, value the share of the company, I could take the stock price divided by the earnings per share, or EPS. Take the stock price divided by the earnings per share and get the PE multiple, or price to earnings multiple. And if I know if I can forecast the earnings per share times the PE multiple, I'm going to get the value of the share. If I take the sales to EBITDA, or sales to earnings multiple, and multiply it by EBITDA, or earnings, T plus 1, I can get the value of the company. So using the multiple approach, I can get the value of the company. I can also get the value of the share. And if from my calculation, the value of the company and the value of the share are higher than the current sales price of the company or the current sales price of the stock, I'm going to buy it. And if the value of the company and the value of the stock is below the current price of the company and the current price of the stock, I'm not going to buy it. So the valuation methodology, the multiple approach, is used by most venture capitalists, investment bankers, corporate finance people, investors, as one of the main tools to make investment decisions. You can also calculate multiples using two other techniques. One is you can take 1 divided by your discount rate. Could be a way to get a multiple. Well, if I do that, if I take this multiple and multiply it by this cash flow, I'm going to get the same value that I get if I use the perpetuity model. I could also use 1 divided by I minus G, which is a multiple with a growth rate component. I can take that multiple, multiply it by the cash flow, and get the exact same value as the Gordon growth method. Most investment professionals use the multiple approach as opposed to the perpetuity and the Gordon growth. They think of valuations more in a multiple perspective than in these more simplistic methods. And then the last method, which is another extremely valuable method, is the discounted cash flow, or the DCF method. Does anybody have any questions before I do the DCF?
Yeah. Sounds good.
Okay. Some of this should be a review for you guys. Okay. So let's do DCF, or discounted cash flows. And you guys are pros at DCF by now. Brandon, is this working out for you? Brandon, is this working out for you?
Yeah.
Okay, cool. All right, so let's do the discounted cash flow, or DCF. And the discounted cash flow DCF is used by a lot of investors. Okay, so it's really the multiple approach and the DCF. And what you're calculating using the DCF is the present value of the cash flows. And the present value of the cash flows is the sum of your future cash flows plus the terminal value. And I'll get into that in a second. So it's your cash flows, T plus, over the holding period. I'll do a 2-year holding period as an example. Divided by your 1 plus the discount factor for the holding period. So these always match. Plus, you're going to include the terminal value. The terminal value. This is actually what you're going to sell the company, or the stock at the end of the holding period. Okay. So the question is, what does this look like, and how do you calculate the terminal value? Well, I'm going to do a 2-year holding period. So my cash flow T plus 1. So this PV DCF. So in my first year, I'm going to have my cash flow. And actually, the first year cash flow is your cash flow today multiplied by some growth rate. So we take today, grow it out to get next year's cash flow, and that's what we use. And then we're going to divide that by 1 plus I to the 1. So that's the first year. And again, that could be earnings, EBITDA, earnings per share, net operating income for the real estate. It's whatever you're trying to value. Then you're going to get your second year cash flow. And usually to get the second year cash flow, you got to grow out the first year cash flow to get the second year cash flow. Got it. Now we got the cash flows. Now I got to get the terminal value. So to get the terminal value, this is really critical for you guys to understand. So to get the terminal value, you got to grow the second year cash flow out 1 more year. So CFO T plus 3. Then you're going to take that cash flow and either you divide it by the discount rate if you assume that the cash flows are going to remain flat forever. That's a conservative, approach. Or if you think that the cash flows are going to grow at a constant rate forever, which is probably more likely, then you're going to use the Gordon growth model to calculate the terminal value. And then the last method would be you multiply the cash flow by some multiple that you've forecasted, into the future to get the terminal value. Then you take the terminal value and divide it by the same discount factor. in the last year of your holding period. Then you discount these cash flows to the present to get the present value. Then what you can do, I didn't do this in the last class, but what I can do is I can subtract the cost of what I purchased the property or the company or the stock for, and I can get a net present value, or it's called an NPV, net present value. And if it's positive, we're going to buy the company, buy the property, buy the stock. If it's negative, we're going to reject it. Okay? And this is your midterm. This is all the capital budgeting and stuff that you're starting to read now in the next chapters. 10, 11, 12, 13. So that's the discounted cash flow present value approach. So the key to this, the thing you need to remember, is to calculate the terminal value. You need to grow the cash flow in the last year of the holding period out one more year. And then you could either divide it by I minus G, or multiply it by some multiple to get the terminal value. And then you divide that terminal value by the same discount factor that you used in the last period of your holding period, because the assumption is that you're selling the property or the stock or the company at the end, like in December, end of December of the second year. Okay. Any questions on that?
None.
Okay. And then for the rest of the quiz, I provided you with the solutions so you can calculate and work out, these problems. There's a lot of investment decision-making problems in here on page 6 and 7. And then you want to make sure that you use the bond formula, for this one here, the annuity formula to get the value. And then you want to make sure this one right here, this the yield to maturity calculation, the 810. The approach to this one, it's supposed to be an interpolation, but what you're supposed to know is that if the stock price right here at $868.43, if the stock price is $868.43, it's selling at a discount to when it was issued at par, and par is 1,000. So if the stock price is trading at a discount, it means that the current yield to maturity or the current market interest rates are higher than the 6% coupon rate. So if you run the bond valuation at market interest rates of 7%, 8%, 9%, 10%, when you get to the 10%, the yield to maturity on the bond and the market interest rate is greater than the coupon interest. So market rates are offering higher coupon interest rates than this bond. And if I can get a higher interest rate on market bonds right now than this bond is going to trade at a discount because I can get a bond that has a higher coupon interest rate. If the coupon interest rate was equal to the market interest rate, then the bond would be trading at par, which would be $1,000. if the market interest rate, let's say, is less than the 6%, then the bond, because the coupon interest rate is so much higher than the market interest rate, that bond investors are willing to pay a premium for this bond. But this case, this bond's trading at a discount, so we know that the market interest rate or the yield to maturity has got to be higher than the 6%. What they want you to do is go through an interpolation process of raising the interest rates from well, we know it's not 6, so they want you to do 7, 8, 9, 10. 10 is when you get to this price. So 10% is the yield to maturity on the bond or the market interest rate. Okay, so that's basically the nuance for that one, and the rest of them are pretty straightforward because I provided you with the solutions. Okay. Any questions on any of that stuff?
No.
Nope.